Let me ask you a simple question. If you could only choose one dividend ETF to fund your early retirement, which would it be? Would you go with JEPI, the monthly paying powerhouse with an 11% yield that practically spits out cash like an ATM? Or would you side with the legendary SCHD, the dividend growth juggernaut that's known for rock-solid consistency and compound growth? Both are top tier in the world of passive income, both have massive cult-like followings, but which one actually works better, not just on paper, but in real life, for someone who wants to retire early? In this video, we'll break it all down. No fluff. We'll look at yield, taxes, dividend growth, real retirement scenarios, and what happens when the market turns ugly. Let's find out which one gives you the best shot at retiring early and staying retired. Stay tuned. JEPI. Since its launch in May of 2020, the JP Morgan Equity Premium Income ETF, better known by its ticker JEPI, has exploded in popularity. With nearly $40 billion in assets under management, JEPI isn't just a trendy pick, it's become the go-to ETF for income-focused investors. Meanwhile, SCHD, the Schwab US Dividend Equity ETF, is a legend in its own right. It's not as flashy, it doesn't pay monthly, but its long-term performance, consistency and tax efficiency have made it a core holding for early retirees and serious dividend investors. So which one deserves a spot in your portfolio? To answer that, we need to break down their strategies because these two ETFs are built very differently. Let's start with JEPI. JEPI uses a covered call strategy. That means, in addition to holding large-cap US stocks, it also sells call options on the S&P 500. This options income is paid out to shareholders in the form of monthly distributions, and that's how it gets to its monster yield of over 11%. But there's more to it than just options. JEPI also holds something called equity-linked notes, or ELNs. These are hybrid investments that combine the features of bonds and equities. Up to 20% of JEPI can be allocated to these ELNs, which adds a layer of income and lowers volatility. But it also adds a layer of opacity because JP Morgan doesn't fully disclose what those ELNs are linked to. Bottom line, JEPI's income is high but variable, tied to market performance and a bit mysterious. SCHD takes a classic dividend growth approach. It holds high-quality US companies with a strong history of paying and increasing dividends. It tracks the Dow Jones US Dividend 100 Index and screens for strong balance sheets, solid cash flow and good return on equity. There are no options, no ELNs, no surprises. SCHD pays a quarterly dividend and its yield is currently around 3.6% to 4.2% depending on the market. That may seem modest compared to JEPI, but SCHD is all about growing your dividend income over time. Let's get honest for a moment. When you're chasing early retirement, yield matters. You need income now, not 30 years from now. That's JEPI's big pitch. With over 11% yield, if you invest $500,000 into JEPI, you're looking at $55,000 or more a year in income. That's enough to fund a pretty comfortable lifestyle in many parts of the world without selling a single share. Remember, the right yield can make all the difference in achieving your early retirement dreams. But here's the kicker. JEPI's dividend isn't growing. In fact, if you look back at its track record since 2020, there's virtually no upward trend. Some years it pays more, some less, but it mostly tracks the market. When the S&P 500 rises, JEPI's income rises. When it falls, JEPI's income drops. That's a big risk if you're relying on that income to cover rent or groceries. Now look at SCHD. SCHD's dividend has grown every year since its inception in 2011. Even through downturns like COVID and inflationary shocks. In fact, its 5-year dividend CAGR, or compound annual growth rate, is about 12%. So, while $500,000 in SCHD may only pay around $20,000 in year 1, by year 10 that could be $60,000 or more, assuming continued growth and reinvestment. This makes SCHD a compelling choice for long-term dividend growth investors. SCHD is the long-term winner if your goal is to build an income stream that keeps pace with inflation and gets bigger every year. Let's talk about risk. JEPI, because of its covered call strategy and ELNs, is less volatile than a regular S&P 500 fund. That's a good thing. You won't see massive drawdowns during a crash, but the trade-off is that you also cap your upside. When the market surges, JEPI underperforms, because those call options limit gains. SCHD, on the other hand, rides the market more naturally. It doesn't cap gains, and it doesn't cushion the falls as much. You'll feel the ups and downs more, but over time it tends to outperform in total return. And that's the key word, total return. If you're reinvesting dividends, SCHD has historically outperformed JEPI in both bull and bear markets. And even if you're withdrawing dividends to live on, SCHD has kept pace better than most people think, especially when you factor in taxes. This is where the real money is made or lost. If you're investing in a taxable brokerage account, JEPI can be a tax nightmare. Only a small portion of GPI's income is classified as qualified dividends. Most of it is considered ordinary income, or even worse, return of capital and other income types that may be taxed at your marginal rate. SCHD, on the other hand, is nearly 100% qualified dividends. That means you pay 0 to 15% taxes on your income, depending on your tax bracket. Put simply, if you're not in a Roth IRA, SCHD is much more tax efficient. And speaking of Roth IRAs, if you're planning to retire before age 59 and a half, you can't touch your Roth without penalties unless you're careful. That makes taxable accounts crucial, and that's where SCHD shines. One last thing to consider, fees. SCHD has a rock-bottom expense ratio of 0.06%. That's just $6 per year on every $10,000 invested. JEPI, 0.35%. That's nearly 6 times higher. While that might not seem like much, over decades it adds up, especially if you're reinvesting. So what does all this look like in real life? Let's take 2 investors. Investor A, age 30, invests $250,000 in SCHD, reinvests dividends and plans to retire by 45. Investor B, age 45, invests $500,000 in JEPI, uses dividends to cover lifestyle now and doesn't care about growth, just wants income. Both make great choices for their goals. But if Investor A chose JEPI, they'd miss out on 15 years of dividend growth and compounding. And if Investor B picked SCHD, they might not generate enough income to retire immediately. It all comes down to this. There's no universal winner here. If your goal is to retire right now and you need monthly income, GPI is hard to beat. If you're building for the future and want growing income, tax efficiency, and compounding power, SCHD is your best friend. Personally, I like to think of them not as competitors, but as teammates. Why not build a dividend portfolio that includes both? Use JEPI to bridge the gap until SCHD's dividend snowballs. Use SCHD to build a foundation of growing, tax-efficient income that lasts for decades. Whatever you choose, just make sure your strategy matches your timeline, your goals, and your risk tolerance. Early retirement is possible. You just have to build it the right way. If you found this helpful, don't forget to like, subscribe, and drop a comment. Are you Team JEPI or Team SCHD? And if you want to see exactly how much income these ETFs can produce with $100,000, check out this next video here where I run the real math. Thanks for watching, and I'll see you in the next one. In conclusion, both JEPI and SCHD offer unique advantages for dividend investors. Consider your financial goals and risk tolerance when choosing the right ETF for your portfolio.